What's up, everybody? Before we get started on the show, I just want to give a quick shout out to our new Forward Guidance newsletter. It runs 5 days a week and talks about all things macro, digital assets, and how the two worlds are starting to collide together. I'm a writer for it at least once a week, as well as a very talented editorial team. And so check the link in our description to go sign up today. It's free and you won't regret it. All right, back to the show. What's going on, everybody? Welcome back to another Roundup edition of Forward Guidance. We have the trio back in action. We're back in our metaverses, looking at our cameras on our internets. We're no longer permissionless, but we're here regardless. Tyler, it's great to have you back. What's going on, man? We missed you.
Yeah, nothing much. Just watching this market grind higher every day and laughing in the bear's face. But that's it.
We're trying to be humble, but we're also laughing a little bit.
Yeah.
Quinn, what's up with you?
Yeah, happy to be home. I was in on the West Coast and have one more trip to New York next week, and then my work travel's done for the year. So I'm feeling good. I'll be locked in.
When are we going to get Quinn on that piano in the back there jamming out? I need a little what can you play on that thing?
I can play Our Country 'Tis of Thee. Maybe I'll start out next Friday. Perfect. Oh shit, I'll be in New York the Friday after.
Okay. I'm looking forward to it.
Nice.
I'll wear my whiff hat for that one instead of my Don hat.
I need one of those.
Hat stays on, man. You should be rocking both those at the same time.
True.
Guys, economy's doing well. I'm not seeing a recession. You guys seeing a recession? We just had the GDP Now estimate that got revised yesterday based off a hotter than expected retail sales data. We're at 3.4% now on the Q3 Atlanta Fed GDP Now forecast. At the same time that yesterday we got also an update to initial jobless claims, which came in softer than expected. And I think, something that we're talking about live when we did this live last week at Permissionless is something Quinn and I were talking a bit about is how we might see a lot of noisy data coming out of the labor market for the next while. I think it'll be marginally less noisy than we expected because the hurricanes weren't quite as bad as we expected. But the fact is there's still going to be some noise. So we got to take some of that data with a grain of salt. But overall, we're getting a strong GDP prints here at the same time that we're seeing jobless claims continue to trend lower. What are you guys seeing?
I think it's funny. I saw some tweets, some of the people who were in our camp of the economy's fine, kind of saying the rate cut's already working. It's like, there's very little chance that this improvement in economic data is from a rate cut that occurred today 1 month ago. And this data is coming out now from the previous, it doesn't feed through that quick. It's hard for me to sit here and say the market doesn't appreciate how bullish the environment is because stocks are at all-time highs and they make new all-time highs every day. But we're getting every month or two, I update my macro views and framework for the next coming 6 and just rotating. And I wrote, if we just get 50 bips in Q4 of cuts, that's very, very constructive. The economy is fine. And then it was okay, if we get 75, that is unbelievably bullish. Now it's we're getting handed 75 and potentially the extra 25 in December comes off the table or it gets pushed to Q1 or whatever. But this environment is so liquidity positive and the economy is inflecting without the effect of the rate cuts already. And so, I'm not here saying stocks are going to go to a 30x forward PE, but I said it before. I said, if the spice is flowing, it will find a place. And we're seeing that in crypto and Bitcoin, which is probably, in my opinion, going to break out pre-election.
Yeah, I mean, I'll let you go in a second here, Todd, but just want to emphasize how quickly we've changed from it's so over to we're so back. This chart I saw the other day from Bank of America that just really hit it home for me is that we've just gone from just some of the largest increases in global growth expectations. It's been an insane move. So, we talked a lot about this idea of this growth slowdown, growth scare in the summer. During that time, we saw the economic surprise index kept surprising to the downside, and now we're basically in the complete opposite. And just really want to emphasize how quickly things have shifted. So it's been quite interesting. And to your point, Quinn, a lot of the dynamics of those rate cuts, I don't think have come in. And even the things that have come in are dynamics like the long bond yields have been going higher since the rate cut. So it's almost been the opposite. Like I was looking at some of the mortgage refi index this week, and that actually came in lower because mortgage rates have been going higher since the cut.
I put in a chart, where is it? Chart slide 9, which is the number of companies experiencing upward or downward revisions to earnings by analysts over the past 30 days. And almost everybody has, this yellow line is the downward revision. So analysts have been revising expectations down. Meanwhile, upward revisions are at the lowest they've been. So that just gives you a sense of where the street is heading into earnings here. And next week is the largest pocket of earnings season. And then after that, the buybacks kick in. So we could have some volatility here in the next week, but I don't know. I think largely the economic data doesn't matter in the next month. I think there's way more structural things at play into the election than, a one-off PCE data point or whatever it is. What I'm really looking at right now is the volatility term structure, which every hedge fund and systematic investor has already bought protection in November and late October, and the bleed that's going to come from that as every day that goes by and is just a theta decay, time decay on the options they bought to hedge out the election. And we can talk about that. I have a couple of good charts later, but I think the economic data is just kind of a wash here for the next month. And the more important thing is, earnings and buyback flows, we should be concentrating on.
Yeah, I fully agree. I mean, like if you look at CPI print last week, like it's like 10 basis points above on core, but shelter is lower. And then you look at like, some of the labor market data, I think that's going to chop around for a while. So I totally agree. I feel like we're in this realm where we're just sort of going to chop around in near Goldilocks. And to your point about earnings revisions, in terms of forecasts, we got to really hand it to these Wall Street analysts. They've really baked this cake nicely. This chart from Yardney Research, I find really hit it home as well. That just shows the earnings per share forecasts for Q3 and Q4, and they've just been basically in a constant downward revisions, setting us up really nicely. You just think about the mindset over the past summer where they've been looking at some of the data and expecting a quite significant slowdown, almost recession, but now we're sort of seeing the opposite occur right at the time where all these earnings are coming in. So, they're really setting this up nicely for us here.
Shout out to Yardney. He's been so good. I have a great story. Like I'd say 10 years ago, I was at Franklin Templeton, and he came through to talk to a bunch of PMs and analysts. And I sat in, and he goes, the past 20 years is largely synopsized as essentially Chinese slave labor is what allowed the U.S. economy to grow like this, and it's just not going to stop. And he's been spot on. I mean, he said it in such a fashion where everyone was shocked, but it was so true. That's what's allowed a lot of the disinflationary pressures of the past 20, 30 years. But yeah, shout out to him. And he really nails the sentiment from an analyst standpoint too.
Yeah, I agree. Really great charts.
I think just while we're on the topic of near term kind of actionable markets, it's like everything I look at, I've been this week, it's like we're at this point where we're at monthly OPEX, things are overextended, overbought, momentum's huge, right? It's like this point, I would say, in the market where your instincts kind of saying, trim, and we might be at the top end of the range. But we've also been playing that game for the last 7 months, and I just find it very difficult to do that here. I think it's interesting because we've had this bump in assets, Bitcoin, stocks, the 10 years higher, partially in a big way, probably due to a Trump bump. But if you look at some of these traditional Trump trade metrics like Geo Group or Fannie and Freddie, they're not yet at year-to-date highs to their benchmarks. Like small caps, for example, they're, in some cases 15% off. So I think there's still a lot of meat on this bone left. And on top of that, we've had a dollar rip and on the back of yields, which has been a bit of a scare. And the days that we've seen risk off in the last week or two have been from dollar strength, right? Liquidity issues, inflation scares. But when you look at the Middle East events, which a little bit have gone quiet, there's actually an avenue here for a at least multi-month peace deal now that Israel feels like they got the leader of Hamas. They've obviously dismantled Hezbollah in an interesting way. There's an avenue here, and I think that's part of why you're seeing oil roll off is the geopolitical premium is washing away. Funny enough, at the same time that yields have spiked on the Trump trade. And if you look at the disconnect between oil, the best kind of market inflation proxy, and yields, there's a huge gap. And personally, I think that yields cool off here, right? Like, I think the market, like the bond market is a behemoth slow mover. Like there's a Trump effect, but Trump, there's not inflation and growth the second, the election happens. So, I think yields cool, which means the dollar probably cools and is very liquidity supportive for risk to continue despite being at this kind of, call it range high in most assets, not just Bitcoin. So I this is kind of one where I think you just get in position and wait and be patient and not try to get cute. But that's kind of how I'm seeing things. I don't have a super strong near-term view like next few days, but I do believe that there's a above market odds that Bitcoin, for example, breaks out pre-election, because all it takes is like his poly market odds to go from 60 to 65 or to 70 in the next week, and you can't just wait for the election day to take.
Quinn, I just want to contextualize what you're talking about here in terms of this recent Trump trade that's been emerging. And fortunately, you wore your hat today just so that we have no confusion about where your predispositions lie. So thank you for that. But so I just want to start off by looking at the Nate Silver forecast. So this has been pretty dominant for Harris over the past month, but has shifted as of yesterday to weighing towards Trump winning the election. And then if you look at, obviously, Polymarket's been the big one in the news. There's been some people trying to parse through whether this is just some whales moving the odds. Obviously, again, just to reiterate that this is a betting market, not a polling market. So you do have to consider these things. But when you triangulate all these dynamics, like I just showed with the Nate Silver forecast, like the trend is towards Trump right now and away from Kamala. And then the same as well with Kalshi, we're seeing some convergence there as well with Trump odds heading significantly higher as well. And all of this leading to higher odds of a Republican sweep of Congress as well as winning the presidency. So based on everything that's been happening over the last week, what Quinn's talking about is that we've started to see markets price in those Trump trades that we saw, I think, last in like July or something like that. So higher long bond yields, gold's been soaring, Bitcoin's been soaring. Equities have been liking it as well. Obviously, we can unpack some of the potential implications of a Trump election in terms of fiscal deficits and tariffs. But yeah, the market is starting to get more confident with a Trump win. Tyler, what are your thoughts on all of that? What are you seeing?
One divergent thought is there's this guy, I think Daniel Lacal. He's a perma bear, and he's talking about interest rates are rising, watch out. But they don't even look at credit spreads. Treasuries sometimes can rise because growth is better, believe it or not. And treasury yields rather than just, inflationary spiral. And now we're seeing today this peace dividend in global war, whatever you want to call it. Pippa Malmgren's talked about it. Perhaps Trump is actually, going to cause a lot of peace across the world. Believe it or not, like that actually could happen. And oil in that case, what happens when, Trump is very pro pumping oil in the US and you have oversupply globally, and OPEC is a cartel. What a cartel does is they keep the price artificially high of any commodity or, any industry. It's like the big tech, you could say, is a cartel. But in that case, the disinflationary pressures that could be unleashed by breaking up a cartel are pretty substantial, and no one really has brought that up. I don't see that as a big narrative here, and it's counterintuitive because you might have a giant fiscal push, fiscal deficits, and could oil go down? Possibly. I mean, that's really crazy. One other thing Pippa Malmgren brought up was Antarctica is this new place of geopolitical war. Did you know Antarctica has over 15 years of global demand in supply, like of supply in Antarctica? So potentially, like that could be, a place where they open up drilling and it opens up a whole new field for disinflationary pressures. Let alone, Trump policies along with that. If you have Musk go in, think about how much unproductive money goes to the government. And if you create that productivity from the government spending to productive sectors of the economy, massively disinflationary. So like you don't necessarily have to see treasury yields rise. Maybe they might rise because growth is so good. But like the narrative that, we're just going to go into some inflationary spiral here under Trump is not necessarily the case. Now that under Harris, I'm not exactly sure how to play that. I think her policies aren't as disinflationary, but I could go through a couple charts if that helps.
Yeah, let's hit some charts here.
Hit me on slide 26. So this is, first off, Piper Sandler has the best derivatives guys on the street. So I stole this from them. Just shout out to them. And this is Trump's odds on Polymarket. You showed this, but next to the KRE, which is the blue line. And it's kind of fascinating that the banking sector really likes Trump because maybe that it creates pro-lending, pro-growth policies. And then you just get that money multiplier and it becomes self-fulfilling. Like that's a possibility. To Quinn's point about the dollar rolling over here, I wanted to show slide 27. This is the yen. Now everyone forgets about it, but
nobody's talking about the yen anymore, man.
No, but I watch every single day. I watch the yen every single day, so it's definitely gotten weaker. But this looks like it's kind of rolling over on a MACD basis, the momentum indicator on the bottom. When that white line crosses the red line, it kind of goes lower. And then if you go to the next slide, that means the yen is strengthening, by the way, which means dollar would be weakening. This is the weekly chart of the yen bumping up against, the 50 weekly chart. So that almost looks to me as if it's a giant head and shoulders. I'm not like a technician by any means, but it's running out of a lot of momentum. You can see the yen strengthen here, and then the dollar gets weaker for the next, 2-3 weeks, anticipating a Trump win. And that's pretty good for global liquidity. So
as long as it doesn't strengthen too much and unwind, a carry trade significantly.
Yeah, which they're not. There's no carry trade on one. That already happened. Right. A lot of it, the positioning is actually flat. A lot of spectators are long.
I feel like we're like the exterminator crew going after all the bears. Like, when the yen carry blow up was happening, we're like, it's a one-time deal. It's done, and now and then it went to like the recession bears and all this. But if you go back and listen to these episodes, or maybe it's on the margin then around the yen, maybe it's the week before, week after, or week after, we talked about what this means. I think there's a lot of signal in this chart for other trades, meaning what else happened when the yen strengthened and the dollar rolled? Small caps. You just pointed KRE. Okay. Oh, I continue. Sorry. I'll
hit you with slide 25. Right.
Amazing.
Okay. Slide 25.
Damn, we didn't even plan this. We didn't even plan this.
We're just that locked in.
IWM seasonality heading into November. This is for the past 10 years. Look at November performance of IWM the past 10 years. And so you're heading into potentially weak dollar environment, IWM. And then I'll give you a kicker. And I'll stop bringing up Carvana and Rocket Labs every week because I feel like I'm beating a dead horse on these things.
Jack Farley's rolling in. He's gonna have a word with you.
Yeah. So, but go to slide 31. I think this says it all here. This is GDX. So this is GDX on, what is that, a 15, 20-year basis. And, another technician, but there's like long-term cup and handle. You have a decade cup and handle.
Tyler, what's GDX for those that don't know?
That's the large cap gold miners index. And I'm going to just give you a rough market structure type thing. And this is very basic, but then go to the next slide. So you see the setup technically. This is the all-in industry all-in costs versus the gold price from Haywood. So if you look at the gold price, it's at all-time highs, but the all-in cost of gold miners, there's a massive spread here. It's actually dropping, or not dropping, but it's the price of gold is rising a lot more than the cost. So, which is a great thing for gold miners, so bigger margins. And then if you look at the spread, look at the next slide. This is from the Piper guys. This is a little bit derivative-y. Piper, shout out to them. The gold skew, we have not seen gold like this on past breakouts. So they say the lower panel is GLD. This is the gold spot ETF. 3-month, 90%, 10% skew. So this is basically the cost of your 10% out of the money puts versus the cost of 10% out of the money calls. So calls, even though gold is going up here, you'd expect calls to be way more expensive than puts, right? That's not the case. And it's breaking out, and people aren't even there on the derivative side to buy these things. So like the sentiment, this is just sentiment check that people aren't overly exposed to the long side. Now, not if you look at the skew of Taiwan semi, it's actually the opposite. People are long calls there, but we're getting too far in the weeds and positioning. But this is really fascinating to me that gold is breaking out and no one's really there still.
It feels like a really quiet bull market. I mean, obviously the Peter Schiffs have been yelling about it, but aside from that, it's been a pretty quiet for like just how bullish the market and this chart looks like.
Yeah, that, and I mean, I'm showing this basically because Bitcoin, I think, is the better play macro wise. It's better supply and demand dynamics. So I'm showing gold, but like theoretically, there are a lot of the same trade on global liquidity. And I don't even hear a lot about Bitcoin right now. Like it's almost at 70K. It's within spitting distance of, breaking out of a massive resistance. And I haven't gotten a text from my, mother-in-law asking, hey, should I, buy some Bitcoin? When that happens, I'll let you know. That's the
Tyler, what are your TradFi buddies saying? Because Quinn and I were just at a crypto conference last week, so we've been hearing about Bitcoin nonstop. But what's outside of that world talking about? Are they saying anything yet?
Okay, this is great because there's a stock that issues convertible debt and buys Bitcoin. Can't say it, but you get to catch my drift. And I keep asking everybody on the street, are you watching this? This guy is rewriting textbooks, corporate finance textbooks. And not only that, but Metaplanet's doing it over in Japan. And I'm like, why aren't there more people mimicking this? Because you're essentially arbing the boomer TradFi fixed income market for this new asset that has insane supply and demand dynamics. And then you can potentially generate massive yield on it once the ETF options market opens up. But I've tried to pitch this to a bunch of like companies in terms of why aren't there more people doing this? Because the dilution of the currency is just, you're going to lose, massive amounts of money sitting in treasuries relative to, the deficit spending they have to do. And it's mind-boggling how like these MBAs and from corporate finance backgrounds cannot wrap their head around what's going on. So my point is, the sentiment from the TradFi world is, it's a stupid, this is dumb still. Like, I don't think a lot of people have exposure to it, but they're not bulled up like they were in 2021.
No, and at the first chance they could find, they're just like, oh, the trade of short Microstrategy long Bitcoin got shopped around as like a free trade. It's just like, oh, this is guaranteed, like this is going to go out. And obviously the exact opposite has happened. That's where the bias lies for the most part.
Yeah, well, Bitcoin on your balance sheet, and this is like, we pound this home all the time. Bitcoin on your balance sheet is way better than owning a Bitcoin in ETF. It's an ARB because you buy an ETF, you have to pay fees on that. You have to pay custody fees essentially, and you don't even get to generate yield off the Bitcoin in the ETF. If you own it as a corporation, eventually you'll be able to lend it out for a certain yield. Like it's a massive ARB that's going on here, but no one's paying attention to it. And eventually, people will come around to it, and then everyone will be doing it. And that's just kind of the nature of first movers. But it's just shocking to me that more people haven't taken the risk, especially when, if you look at a lot of companies, they're just walking zombies.
Yeah, on the gold. So I have a brewing contrarian take on gold. It's not super high conviction. So I've been saying since the summer that the best analog for the period of time we're entering is Q4 2020, where gold led by a very, quite a ways, and then handed the baton to Bitcoin, and actually gold stalled out quite a bit uh, as Bitcoin was really zooming. So I agree with you that Bitcoin is a better play here. The thing on gold is it's a play on money printing, it's a play on fiscal and monetary excess and irresponsibility, and it's a play on geopolitical concerns. I don't know why people have such a hard time understanding that Trump is a peaceful president, considering his 4-year history was way more peaceful than the last. But just objectively speaking, number of deaths, number of wars, number of etc. But that's a negative for gold if he is geopolitically peaceful. It's a negative for gold if oil excesses are released and disinflationary from that perspective.
Is it though? Is it though? Because that's disconnected. I feel like we're at in this point where sovereigns are now buying it as
Yes,
like
agree. But this is the last point. It's a negative for gold if you have an American first president who's enforcing the U.S. dollar and trade and saying if there's that's why I said it's not high conviction, because there's the argument that if oil goes to zero, like just hyperbole speaking, the Fed can cut into infinity and gold is monetary debasement hedge. So that's good for gold. But there is the argument that Trump is so pro growth, rates, as you mentioned, should be rising because of that, and that's typically a negative for gold. And on top of that, you would see less need for this, like, the world's going to blow up in my face hedge. And so I do think that there's a point here where Bitcoin takes the baton and starts just absolutely flooring it, while gold starts to cool off. I might not be there yet. So, I do like gold relatively, but
I'm going to take the contra on that just because I think
finally we got a contra going on.
Yeah, Louis Gobb. I'm going to just disagree with you. Louis Gobb has a great call on gold. He's like, gold is really just a proxy for the Asian consumer. And, if they're going to juice the hell out of these, Asian markets, then
it's an emerging market play.
Yeah. And I think you might have, I think what you're really heading into is Trump will want a weak dollar.
Yeah. To reshore everything you need it.
Exactly. Reshore the manufacturing capacity. And it's going to be bumpy and rocky because you have all these weird FX things going on globally. But on a long term, I think we're going to reindustrialize our manufacturing capacity here, and that's massively dollar weak and probably good for the Chinese consumer.
While we're on this, and I'm sorry, I'm talking a lot, but it's an ode to the people that are offended by the hat. Is I have a great play if you want to. I think it's a win-win. I think you win no matter who wins this election. Chinese stocks, right? Because there's this perception that Trump is bad for China. So if I believe locally that the dollar is topped, that means it's good for emerging markets broadly. The emerging market equity indices charts look fantastic. And on top of that, if you think the Trump trade's overdone, you probably want to long China because there's this commonly. I actually think that China will be fine under a Trump election. I think he will bring their manufacturing here, et cetera. But that's a play. If you want to hedge, you have the dollar abating, plus you have emerging market growth, and you have presumably a better trade if Trump loses, which would be long China. So I think that's a win-win. And the other one, which I think is a win-win, but has popular conception that Trump is bad for, is Mexico, which in reality, friendshoring, reshoring is very positive for our neighboring countries' supply chains and economies. But that's another case where I believe locally the dollar's rolling over. I also think there's this perception that Trump is bad for Mexico. And if you want to play him losing or whatever, or a hedge if you believe he's winning but you still want to benefit, I think both of those trades are pretty interesting setups here.
Guys, I just want to contextualize. You both said you think that the dollar is going to roll over. I believe that as well, but I just want to rewind a few weeks ago to when I was talking about the 50 bips cut that was occurring, and that everybody was talking about the dollar rollover. And I had mentioned that I was pretty bullish on the dollar, and I thought we were going to head higher. And that's pretty much what has happened. And the big reason why is because I thought that there's too many cuts. priced in. So I just want to contextualize where we're at in the dollar, and why I also agree with you guys that we're going to head lower here. So this is just the Fed funds rate curve, and we can just see that, we were pretty aggressively priced. Not quite recessionary price, but man, we were going to be cutting quick there. We've come off that quite a bit, and because of that dynamic, we've seen the dollar head higher as it's priced out some of these cuts because of how forward rate differentials work. And this is just another way of showing that, is that basically, we saw them hit pretty much cycle lows in terms of how many cuts were going to be priced in, and now we're starting to reverse higher. So to our point about the economy, about where the U.S. stands versus other countries, we've seen that dollar move higher. I feel like it's pretty fairly valued now. I feel like we're in a decent spot in terms of how many cuts are priced. I'm curious if you guys agree or not, but for those reasons, I feel like the reversal has occurred now, and then I can see us being, mostly fairly priced, but skewed to the downside for the dollar. With all of that in mind, how are you guys seeing the number of rate cuts priced in versus what you actually believe is going to happen, and versus what the Fed is forecasting?
I believe it is more fair now. And I think everyone up in arms about, oh my God, Trump's going to win. Or if Trump wins, it's the Fed's going to be more hawkish. Well, that's the same thing as me saying, hey, we need less monetary accommodation if the economy's hotter. Like the same thing. And that's not bearish. That's great. Like if a stronger economy. So that's what I think is going to happen. I think, as I mentioned at the start, when I was plotting my Q4 plan, I was like, if we get 50, it's great. If we get 75, like game on. And we're going to get 75. The Fed's not going to abruptly ditch their forward guidance 1 month in. We saw that in the summer, right? I think it was on here where we talked about the Fed's locked in, even though they should have cut in July. They did 50 after. That's why we had the deleveraging event in August. And so I think you get 25 in November. And spilling the beans a little here, but my alpha is that is the actual key here. Trump's, whatever happens the election, we're going to, go beyond 2 days, and the Fed's going to cut 25 basis points again into a very strong economy. And at that point, I think what happens is the dollar rolls and loses its correlation with bond yields, because it's going to be saying, look at what happened in Japan. When Japan was too loose with their monetary policy, the Japanese bond yields rose and the yen declined. That's the market's way of saying your policies are inflationary and negative to your currency. I think that is why these emerging market small cap trades explode no matter who wins the election. And the dollar rolls because the Fed stays on their cutting path. And from here, if they got 75 in the bag after that point. Who cares if they take December off the table and say it gets pushed to January? Like that probably happens. Like I still think there's a good chance we cut in December, but if not, there's probably a digestion period where the market's like, oh my God, it's scary. They're done cutting. No, this is because the economy is freaking hot.
Quinn, just to play devil's advocate on the point of hawkishness, if Trump wins or not, I feel like personally, actually not even personally, just the overall framework of how I think about this is whether the growth is productive or not. So, when I look at drill baby drill type ideas and cutting regulatory red tape, those are very pro-growth ideas in a very positive, like leaning towards productivity boom type of ways. I'm with you that would lead to, in a good news is good news type regime for markets. But if it's because of tariffs and increased trade war that creates a marginal increase in cost for the consumer and canceling immigration, those dynamics I don't think are good. So we need to figure out
without growth. Yeah, I agree.
Yeah, those are inefficient burdens of costs on consumers. So we need to parse the two potential outcomes. So I'm mostly with you that the ideas of drill baby drill and cutting red tape are going to be very good for productivity, but we also need to figure out how likely it is that these tariff dynamics are going to actually come to light.
Yeah, it's interesting because everyone's the immigration statistics, by the way, funny what elections do, they're down huge. There's been an absolute chopping block at the border recently. There's a chart that can show this, but that's just politics, right? I mean, people that's why this immigration situation is where it's at, because they needed to get inflation down. They needed to pressure wages to the downside. And now that the labor market's in better balance and there's an election to win, all of a sudden Democrats have gotten tough on the border. It's just what it is. Like, it's so, yeah, it'll be interesting. I agree. I mean, we need immigration. That's been an absolute driver of the economy, and obviously free trade and everything. So at some point that, America First agenda is I agree, counterproductive. But I think his inner circle is different this time. You have some real, just different, but politics.
I mostly agree. I feel like for that reason, I don't know about you guys, but it feels like the most bullish outcome for markets is Trump winning, them winning the Senate, but having a gridlock Congress where they can still get their Senate appointments. They can lead from that regard, but are somewhat hampered in terms of those really like big tariffy type of bills. That's my intuitive thought, but I'm curious what you guys think. Or do you think like a full red sweep is the most bullish outcome?
I think it's path more than it is like changing like the next 12, like the year from now. I think it just changes the path of like how aggressively the market prices things in.
You know what? To give Quinn some credit here, he said about, I don't know, 3 months ago that Trump could be the great savior. And
I don't know if I
said that. Like I know there, I'm not, we don't want to turn this into like some sort of like right-wing echo chamber. I stay agnostic when it comes to markets, or try to, but there's a lot of the policies that could be very, very solid. I mean, and that could actually be very uniting and bipartisan, on a lot of cases. So what I'm trying to say is that this next Trump presidency could essentially be that first turning type moment that Neil Howe talks about, where you rebuild institutions and you get rid of the government red tape, and then all these things that like need to reinstill American dynamism come to fruition. I don't even, to give Harris credit, like I don't think some of her policies, like taxing unrealized capital gains, et cetera, but opportunity type economy could be great too. I think we're heading in this direction kind of either way of who wins the election. It's just demographics are going to make that happen at the end of the day. So I don't want to completely knock Harris too, but I think Trump is just a faster igniter to that switch.
That's my whole point. I actually agree. People on the crypto side love when I say I think Trump's going to win, but I also hold the same view that I don't think it matters that much, because I think their policies are way more similar than people talk about.
So it's just populism with high deficits.
Exactly. Yeah. I believe the macro rules out, and the macro is, populism and population's voting tendencies are part of that. And I agree that Trump fast forwards a lot of this like digestion period of like society. And, of course I don't think he's literally the best person in the world to represent, but we're in reality and we got to pick between two. And I think that fast speeds up what the country needs to go through anyways.
Yeah. Can I show, this is kind of interesting. This is slide 35. I'm stealing Piper's slides, but to get back to more market stuff on the election. So one of the fascinating things is everyone after last expiry just jumped in. They bought all the VIX protection. They bought the downside, election protection, the volatility curve inverted, meaning everyone was buying insurance for the election all at the same time. And basically what's happened is this is the 1 day implied move on the election day. It's slowly inching lower every day. So basically everyone is selling their protection every day that goes by, because, well, number one, the odds of Trump winning are going, it is getting further apart. But two, when you buy protection a month before it, instead of when the VIX curve is already pretty steep on the front month, you're basically the decay. What happens after the election, after the event risk happens? Bam, VIX sells off really hard. Risk parity funds, because they have VAR mandates, have to relever everything. So there's lots of structural things. And then as a kicker, slide 37, this is where all the systematic stuff to me it's sad that it's this important, but you have $1 trillion of buybacks. This is the light blue bar. This is from Goldman at the end. And of percentage of buybacks that happen from uh, October to November is 20% of the annual executions. So you have a really illiquid period of stock trading into the holidays, but the majority of the buybacks happen then. So after $6 billion per day, every day to close out the year after October 25th. So a week from today, essentially these buybacks kick in again, which is a ball stifler with everybody waiting for the
Yeah.
election. And you have this buyback bid, just operating underneath it. So largely, I don't know, a lot of these events, like even earnings, like you might have one day single stock moves, but there's a lot of these structural flows here, especially, with credit spreads. If you look at the high yield credit spreads, they're at lows. So I just want to knock one more time the bears calling for a credit crisis, and then show that there's systematic flow that's going to happen no matter what, barring the geopolitical event. Like the geopolitical event is really what can derail all this stuff, and
Yeah.
and maybe a Fed pivot to tightening again, which Druckenmiller wants. But
Yeah. Tyler, that idea of I'm just looking at the VIX today, like we're down over 4%. We're below 20. That's really interesting to me is seeing that bleed on it at that you're talking about. Like
it's killing guys.
yeah.
Like you can see it just like, I mean, I should have brought a chart of this, but the Goldman Sachs short basket. So every time that the VIX falls, these systematic guys have to cover their shorts. And it's just, this thing looks like an inverse Head and Shoulders is going to take off all the shorts. And that's my point about Carvana and Rocket Labs and even non-profitable tech companies. They're breaking out here to the upside, but it's all because the systematic guys are essentially short these sectors. And now the VIX falling, you're going to get squeezed out of it.
Something I want to ask you guys about is actually, so, we always hear about hard landing, soft landing, no landing. I think a lot of people could probably guess where the three of us are in that camp. But what I want to actually talk about is how to contextualize validating which one we're in and how it takes time. So I've seen discussions about how, we've had the soft landing already and we've won and now we're into the next business cycle. Or perhaps, you're in the Jim Bianco camp, which is more about, no landing, or you think the hard landing's still to come. I can give my opinion in a sec, but I want to let you guys start. How do you actually measure, if you're in the soft landing camp, is it already complete, or do we need to see whether inflation reaccelerates after these cuts? How do you guys measure it? And just to really hit it home, like which of those three do you guys think we're in?
I speaking in these tongues of like what Twitter likes to is just it. I don't even operate like. What does this even mean? I'll ask you because Felix, you're a bit more of the good at that stuff than me. I know like 6 words. I'm from Wisconsin, so what I'll just say is, like Tyler's been harping, no recession anywhere in sight. There's been a huge dichotomy between small businesses, big businesses, middle and low income class, wealthy income class. And this is a direct result of Fed policy. And Fed policy is adjusting downwards to improve that dichotomy. And I believe inflation will come back, but it's I believe inflation coming back would be a result of a very hot economy. And if you look at the bank lending growth and many other, I saw Bob, Unlimited Funds guy, Bob Elliott, talking about how we're moving to a credit induced cycle versus income. Again, like I think it's a lot of nomenclature here, like what's credit, what's income. But I agree with his sentiment because that's something we've been talking about. If you look at bank lending growth, it's been anemic. It's been negative in some cases over the last 2 years because the bulk of companies, small businesses, small banks, regionals they've been unprofitable and had horrible balance sheets. That's being fixed. Steeper yield curve. It's now profitable to be a bank. And I think the economy is going to heat up. So I actually, I guess, would be ballparked in the no landing scenario. I think the economy is going to get very hot again. And we'll see in 25 what policies are a result. But if the government's running 7%, 6 to 8% budget deficits, and the Fed's got their foot on the liquidity gas, I don't even know, like, I don't know. I mean, we're quarters away from any potential recession. So
Yeah. To back you up on that, we just saw Taiwan Semi report yesterday, and the CEO said the demand for chips is insatiable. And he said it's also the beginning, not the end. And no, I don't advocate buying that here after the move they just had, but it's more like, and then you see Netflix report, they're up 6% today. If you start getting blowups on earnings, then yeah, be concerned. But I'm not seeing that. There's some things, parts of the economy that are rough, like the lower end consumer. Is that, but did we lend gazillions of dollars to that sector where it would cause an unraveling? I don't know. I think that's partly why the Fed wants to lower interest rates, because that part of the economy is getting roasted. But largely until you see some big blowups or you see credit spreads widen, we're going to stay this course. And that's just where I'm going to keep saying this every week until people pay attention to us.
I think one thing that'll make the people that don't like my hat feel better, that I have an open mind, is acknowledging the fact that everything I just said, extremely bullish. I'm bullish, like the economy, whatever, has occurred under Bidenomics and Harrisnomics. So
Yeah.
like, I'm acknowledging, like, you can hold these two views.
Yeah.
Like,
I mean, like, Quinn, you replied to a tweet of mine where I was saying that, like, in 2022, 100% of economists thought we were about to be in a recession. And you're saying that we would have been in a significant recession if it wasn't for the significant fiscal move that the Biden administration did.
Yeah. The monetary, I mean, the Fed completely backstop. We would have had a great financial crisis type credit event if they didn't backstop these banks. Like, there was real reasons to be fearful, and they plugged the hole overnight on a Sunday, and we woke up and the stock market barely flinched, and we're back. Look,
more acronyms. They love acronyms. We're going to do this. SLI. You're going to go do that.
I would say that my view is, like,
we're a Ponzi scheme, bro.
That's my view, is that I think there needs to be some Wall Street, quote unquote, Wall Street pain to kind of Main Street has been hindered in all these decisions. So I think that's the populist Trump vote, is like the gap in policy making benefits. But yeah, I mean, like, we're just going to trade the market that's at hand, and you can't argue with this liquidity boom. I think it's going to be funny that my prospects for 2025 and 2026 are not, at least at this stage, going to be that great. So I wouldn't be surprised to see Trump handed like a overblown asset market, and the narrative turn in a year from now, like, Trump's horrible for markets, and it's just going to be like, no, it would have happened no matter who's president. So like, it just, it's funny.
I want to quickly show a chart that just goes against, just because I got to, just keep the spiciness flowing.
Yes.
Of just this narrative about the bottom 50% being way worse off since COVID.
This takes a lot for you to do, because you are a Canadian in passive by nature.
Yeah. Yes, exactly. So I'm being bold here, but this chart it's a Twitter account called Bill. I forget the full name, but he has a Patrick from SpongeBob avatar. Anyway, he's absolutely nailed the macro cycle for the past like 4 years, and he put out this chart that just shows net wealth of the bottom 50% in real terms. So let's like underscore that, real terms, inflation adjusted terms.
Mm-hmm.
Their net wealth has soared over the past 4 years. So
that's a good chart. Yeah.
Like, just to throw that out there, that like this K-shaped economy thing that everybody takes as a baseline assumption, you can find some interesting data in there if you dig deep. So, bottom 50% of net wealth in real terms, it's up a lot over the last 4 years.
Yeah, I was just going off of, like, what was it, Dollar General earnings, and saying,
yeah, I mean, that's the easy thing. You see, I like, not to harp on you, but it's just like, somebody will put like a comparison of like Ferrari stock to Dollar General and be like, oh, look, K-shaped economy. But it's like, no, it's just one company sucks and the other one is doing really well, and luxury brands are doing really well these days.
Yeah, but
hey, you can also say this is like government spending and government jobs, etc.
Yeah.
But the stock market's at all-time highs. So every single cohort's real wealth is an asset. Every asset's at all-time highs. Real estate, equities, gold, what you name it. So I think I agree, Felix, but that chart would be more impactful if it was relative, because I think what would be shown is a widening of, everybody's up today. Like,
Yeah.
yeah.
But I mean, but also like real wage growth has been significant, like pretty significant over the last 4 years.
Can I bring up something that's been on my mind philosophically? So this is,
we love when you go into philosophy.
Charlie, are you going to bring up a Russian philosopher again and get us in trouble?
You know what? I am going to bring up somewhat of an economic philosopher. He's a little right-wingy. His name is Curtis Yarvin. He's kind of out there. But there was this part of his newsletter specifically where he calls out Sam Altman, because Sam Altman's like, why don't we have lamplighters anymore? And lamplighters, because technology has made lamplighters obsolete. And Yarvin says, this is kind of goofy, but he says, what happens if AI turns out to be like a natural resource curse for the United States? Meaning it ends up being so productive. Like if you have a third world country and they find gold, the country devolves into like an autocratic kind of jurisdiction, because this one resource, everything in that country goes to just getting this resource out of the ground, and then this oligarch of wealth,
like Saudi and their recent initiative to diversify from oil, or Venezuela. Exactly. Yeah.
And so everything becomes way more political in that environment. So if you have a massive productivity boom from AI, then what actually ends up happening to that economy? And I thought that was a really interesting thought experiment. If it ends up being the natural resource curse, I saw that TSM earnings and I'm like, holy shit, like maybe I'm open. I called, being skeptical of large cap tech earnings. So I lost on that one. But now that this thing is actually still going, and my wife works in retail, she's like, we just use this technology called Listen Labs that makes my job 10x more productive. She can do like 5x the work that she used to do. Imagine that all these productive things happening in the economy, there's gonna be massive winners and massive losers. But if AI, like 10 years from now, takes all the capacity away from other parts of the economy, it's kind of scary, like the dystopian world we could be living in there. And it becomes highly political, which makes guys like us, the media, our voices are way more powerful. In that world, politics and media become a lot bigger. But
as long as we can authenticate ourselves as real humans.
Yeah.
I think
instead of agents. Yeah.
I think that sentiment's accurate, but the optimist spin on it is like, you could have said the same thing about the internet, and there was like a digestion period, right, into the world of internet and things. And like it did put it put Blockbuster and it put Motorola and it put all these companies out of business. But then, we're better off for it. I think what that leads to is like a complete reset of our education system, our government, are like these rules. I mean, the securities laws drafted in the 1940s, right? Like capital formation made for a time when you communicated through mail, and now we're communicating instantly all day on Bloomberg. Like, so I think that sentiment is real, and there definitely probably is social programs required to like facilitate the 40, 50, 60-year-olds who are out of jobs and can't retire yet, but like don't know AI and computers. But also it's like, I think that's being encompassed in the populist movement, because I think the early signs of that are already here. And what it requires is a rehaul of your education and big parts of society for the better. Usually, it can end worse, but
his point in that, the Yarvin guy, I think he said something like, you have to bring back artisanal goods, like people handmade things, because you need people to be doing things that have purpose. And I thought that was really interesting. Like I was like, I should start an artisanal,
you know what that reminds me of is, have you ever been to Norway? This is a country that's one of the wealthiest countries in the world. And when you go to like a city like Bergen, like everybody drives like $100,000 car. But no one has but like 75% of people also own art galleries. And you're like, what is the economy here? And it's just because they're so rich, like from oil, which is also hilarious because all the cars are electric and they like pontificate on green. But the reason no one has to work is because they make all this money off oil. And then it's interesting. I'm generalizing, and so for anyone from the Nordics, please don't hate me for these, but these are observations of a foreigner going there. And a cheeseburger is like $30.
Humans are hypocritical no matter what. You just no matter what you do, like it doesn't matter.
Unbelievable place. I'd love it.
Guys, I think we got to wrap it there. Unfortunately, I got to jump off, but it was great to get the three of us back together. Tyler, we missed you last week in Salt Lake City, but we'll do it live in March next for DAS. Exactly.
Sounds good.
Cool, guys. Have a good weekend.
All right. Thanks, boys.
See ya.